October was supposed to be Uptober, a month of celebration, new highs, and the triumphant return of bull market euphoria. Instead, it delivered one of the most violent and destructive months in crypto's history. It started with Bitcoin smashing through its all-time high of $126,000, and the mood was electric. But just days later, that optimism was vaporized in the single worst liquidation event crypto has ever seen. Now, as we limp out of October and into November, the market is scarred, sentiment is in the gutter, and many are wondering if the bullish dream of Q4 is officially dead. My name is Lewis, and today we are going to dissect the anatomy of October's chaos, examine the forces that could still save the fourth quarter, and answer the million-dollar question: can Bitcoin still hit new all-time highs by the end of the year? First things first though, none of this is financial advice. It's educational content intended to inform you about the current crypto market dynamics. Please consult your financial advisor before making any moves in the crypto space. So, how did Uptober go so horribly wrong? Well, the month began exactly as the bulls had hoped. The narrative was simple and powerful. October has historically been Bitcoin's strongest month, delivering an average return of over 20% in 10 of the past 12 years.
Nice.
This seasonal tailwind, combined with growing institutional demand, pushed Bitcoin above $120,000 for the first time since August. And then, on October 6th, it happened. Bitcoin sliced through its previous peak, setting a new all-time high of $126,296, and the market was euphoric. Almost $100 million in short positions were liquidated in a single hour as traders piled in, expecting the next leg up. But that euphoria was built on a mountain of hidden leverage, and on October 10th, that mountain became a volcano. The trigger was a geopolitical black swan. On Friday afternoon, when traditional markets were closing, President Trump launched a new salvo in the simmering trade war with China, announcing an imminent 100% tariff increase and new export controls on software. The crypto market, which never sleeps, reacted instantly and violently. What followed was not a correction, it was a full-scale deleveraging event. In the first hour alone, $7 billion vanished. And within 24 hours, that number swelled to over $19.37 billion in liquidated leveraged positions, and 1.6 million traders were wiped out. Now, let me put that number in context for you. When the FTX exchange collapsed in 2022, it triggered $1.6 billion in liquidations. The global COVID panic in March 2020 saw $1.2 billion vaporized. So, this single event in early October was larger than both of those combined, times 10. Analytics firm CoinGlass confirmed it was the largest single-day wipeout in crypto history, and they noted that the true scale was likely closer to 30 or even 40 billion, as some exchanges report data with a delay. The price action was, you guessed it, brutal. Bitcoin plunged 18% from its all-time high, crashing from over $126,000 to a low of just over $104,000. Ethereum fell over 20%, breaking below $4,000. But the real devastation was in the altcoin space. While Bitcoin and Ether lost 11 to 13% at the peak of the crisis, mid and small cap altcoins experienced a complete catastrophe. Coins like Solana, Dogecoin, and XRP suffered 60 to 80% losses as liquidity simply evaporated. Some, like Cosmos, saw their price essentially flash crash to zero before bouncing, and the psychological damage was just as severe. The Crypto Fear and Greed Index, which was sitting comfortably in greed territory just a week prior, plummeted into extreme fear, hitting a low of 22. On X, the phrase, "I survived the $19 billion liquidation," became a somber badge of honor. Well-followed trader Pentoshi posted, quote, "There are a lot of people in incredible pain right now, myself included in that." And just when the market was trying to find its footing, it got another curveball. On October 29th, we had the FOMC meeting. As expected, the Federal Reserve cut its benchmark rate by 25 basis points and announced it would end quantitative tightening, or QT, the process of shrinking its balance sheet, on December 1st. Now, normally, a rate cut and the end of QT would be wildly bullish for risk assets like crypto. Signals easier money and more liquidity. But the market sold off, with Bitcoin tumbling below $110,000. Why? Well, some say it's because Fed Chair Jerome Powell struck a hawkish tone. He warned that a further rate cut in December was, quote, not a foregone conclusion. Far from it. That sliver of uncertainty was enough to spook a market that is still deeply traumatized. So, when you look back at the month, it's clear. October 2025 will go down as the red month that broke a decade of bullish seasonality. It is on track to be one of the worst performing Octobers since 2014. The quote-unquote Uptober meme is officially dead. So, where does this leave us for the rest of Q4? Is the bullish thesis completely broken, or was this chaos actually a necessary evil? Before we answer that though, navigating this kind of extreme volatility requires having the right tools and access to reliable exchanges. And if you're looking for the best platforms to trade on, then you absolutely have to check out the Coin Bureau deals page. That's where you'll find exclusive sign-up bonuses of up to $100,000, trading fee discounts of up to 50%, and deposit cashbacks of up to 75% on some of the best crypto exchanges in the space. All you need to do is hit that link in the description or scan this QR code on your screen. Once you're on the deals page, you could browse all of our offers across a range of trusted exchange partners. Just click one of the Sign Up Now buttons and it will take you right to the deal. Now, these offers won't be around forever, so be sure to take advantage of them while you still can. Okay, so now it might sound strange, but the first argument for a Q4 recovery is the sheer scale of the October crash itself. Many analysts aren't viewing this as a systemic failure, but rather as a controlled detonation, painful but necessary purge of excess leverage from the system. Think about it. Over $65 billion in open interest was wiped out, effectively resetting the derivatives market to levels last seen in early 2025. The system absorbed a $19 billion shock, and unlike the Terra Luna or FTX collapses, no major exchanges went insolvent. No major funds blew up. Core infrastructure, while stressed, did not break. This painful flush out of what analysts are calling weak hands and reckless leverage could paradoxically create a much healthier foundation for a sustainable rally into the year's end. The second, and arguably more powerful catalyst, is the shifting macro environment. While Powell's comments last week were cautious, the broader trend is undeniable. The Federal Reserve is pivoting. We've had 2 consecutive rate cuts, and the market is still pricing in a decent probability of another cut at the December FOMC meeting, despite Powell's tone. More importantly, the official end of QT on December 1st cannot be understated. QT has been a constant drain on market liquidity, and its conclusion is a significant tailwind that should, in theory, support flows back into risk assets, including crypto. If these macro developments unfold as expected, the result could be a massive surge in global liquidity and risk appetite, setting a near-perfect stage for a breakout heading into the new year. And finally, there's the institutional factor. Even in the face of the worst liquidation event in history, institutional demand remained resilient. On October 28th, just days after the crash, Bitcoin ETFs still saw net inflows of over $202 million. Ethereum ETFs added another $246 million. This wasn't just retail FOMO buying the dip. This was also institutional capital viewing the liquidation event as not just a harbinger of a bear market, but as a prime opportunity to acquire fundamentally strong assets at a discount. The resilience suggests a maturation of the market. The smart money is no longer scared off by crypto's volatility. They're learning to exploit it. And this brings us to the biggest question on everyone's mind. First, can Bitcoin and Ethereum still break through their all-time highs by the end of the year? The short answer is, it's possible, but the path is narrow. The bull case is certainly compelling. Asset manager Van Eck is maintaining its prediction that Bitcoin will reach approximately $180,000 by the end of 2025. Standard Chartered is even more bullish, projecting a potential move to $200,000. These targets are ambitious, requiring a 45 to 60% increase from current levels. But they are predicted on the very catalyst that we just discussed: sustained ETF inflows, improving macro liquidity, and no further geopolitical shocks. From a technical standpoint, however, the picture is one of consolidation. Bitcoin has been defending the crucial support zone between 108,000 and 110,000. And as long as it holds above this level, the path of least resistance remains to the upside, with technical targets near 119,000 and then 131,000. For Ethereum, the outlook is perhaps even stronger. It continues to be supported by strong ETF inflows and optimism surrounding the upcoming Fusaka network upgrade scheduled for November. Analysts estimate there is a 65 to 70% likelihood of Ethereum revisiting its all-time high by year end, with potential targets in the 5,200 to 6,000 zone. However, it's crucial to acknowledge the risks. Some analysts looking at Bitcoin's reliable 4-year halving cycle suggest that we may be nearing the peak of this bullish period. A failure to reclaim the highs soon could signal a longer period of consolidation or correction heading into 2026. So, while a new all-time high is on the table, it is far from a guarantee. Now for the second and perhaps more painful question for many viewers. After the devastation of October, is an altcoin season still possible at all? To be blunt, the immediate outlook is bleak. The October crash was a flight to quality, and in crypto, quality means Bitcoin. We saw this clearly in the market data as Bitcoin market dominance surged to 59%, its highest level in months. Meanwhile, the altcoin season index, a metric that tracks whether altcoins are outperforming Bitcoin, completely collapsed, falling from a reading of 70, which is close to altcoin season territory, all the way down to 26, which is firmly Bitcoin season. The reason for this is twofold. First, in times of extreme stress, capital flees from high-risk assets like altcoins to the relative safety of the market leader, Bitcoin. Second, the market structure has fundamentally changed. The rise of Bitcoin ETFs and corporate treasuries has attracted hundreds of billions in capital that, in previous cycles, might have flowed into altcoins. This has disrupted the traditional capital rotation dynamics that typically fuel an altcoin season. So, does this mean that you should just give up hope? Well, not necessarily. Historically, the most explosive altcoin rallies have always followed a strong Bitcoin pump. The pattern is usually Bitcoin leads, then Ethereum follows, and only then does capital begin to trickle down into large caps and eventually small cap altcoins. We are still very much in phase 1 of that potential cycle. If Bitcoin can consolidate its gains and macro liquidity improves as expected, it is plausible that we could see a shift in momentum by the end of Q4. However, the days of a rising tide lifting all boats, or even meme coins without utility do a 100x, are likely over. The next altcoin rally, when it comes, will probably be far more selective, favoring high-quality projects with clear catalysts, strong fundamentals, and real-world utility. So, where does this leave us? Well, October was a brutal, humbling month. It was a masterclass in the destructive power of excessive leverage and a stark reminder that in crypto, nothing is guaranteed. The quote-unquote Uptober narrative was shattered by a real-world macro shock, proving that seasonality is a guide, not a gospel. But the key takeaway should be this: the market was purged, not broken. The violent deleveraging, while painful for millions, has cleared the path for a potentially healthier market. The institutional foundation held firm, and the macro catalysts for a recovery are slowly aligning on the horizon. The remainder of Q4 will be defined by a battle between the psychological scars of the crash and the fundamental tailwinds of a dovish Fed and improving liquidity. The December FOMC meeting and the official end of QT are now the most critical events to watch. The dream of a bullish end to 2025 is not dead, but it is hanging on by a thread. And if you want to learn more about how institutional players are quietly positioning themselves in this market, you could check out our deep dive on BlackRock right over here. And if you're wondering how the rise of ETFs is fundamentally changing the structure of the crypto market, well, check out that video right over here. Thank you so much for watching, and I'll see you again soon. This is Lewis, over and out.